Are you confident in completing, amending and analysing balance sheets? We know it's a favourite topic of examiners because they understand how difficult this concept is to grasp. By the end of this video, we're going to be able to do all of that and more, effectively and under timed conditions. Let's get into it. The first thing to do when trying to understand balance sheets is to understand the different components that make up each balance sheet. The first is assets. Assets are things that belong to the business. The second is liabilities. These are things that the business owes. On the screen you have 9 different items. You may wish to pause the video now in order to separate these items into assets and into liabilities. Every time that might be a good opportunity for you to pause the video, I'll write in red letters pause in the top left corner. So you've had an opportunity to split those items into assets and liabilities. Let's have a look at what you came up with. In the assets column you should have a van, debtors. Now debtors are people that owe you money, so potentially customers that you've sold goods to on trade credit and now they owe you the money in return. Cash, stock, sometimes stock is known as inventory, and a warehouse you own. Now if you add up all the value of these assets, you get total assets of £190,000. And then on the flip side we have total liabilities. Now these equate to £60,000 and are comprised of creditors. Now creditors are people that have given you or your business credit. Now this could be a supplier, for example, that you owe money to. And then we've got long-term loans. We've got wages, so wages you will owe to employees and staff members. And then we've got a heating, lighting and water bill, which comes to £5,000, and these are generally paid quarterly and therefore are of a liability to your business. Now, what is the total value of the business? You may wish to pause the video now just to work it out. So what is the total value, judging by these figures? Well, if total assets equal 190,000 and total liabilities equal 60,000, that would mean that the total value of this business at this present moment in time is £130,000. And that brings us on to what actually is a balance sheet. Really, in its simplest form, it's simply a snapshot, just like taking a photo, a snapshot of a business at a certain moment in time. Not over a year, like a profit and loss account. This is a snapshot at a specific moment in time that shows a business's assets and its liabilities. In order to further our understanding, we have to classify assets in 2 different groups. So, firstly, current assets. These are assets that a business keeps just for the short term, generally kept for shorter than a year. Whereas fixed assets, on the other hand, are assets a business will keep in the long term. Assets, belongings, that a business will keep for generally longer than 1 year. Now, on the screen you've got the 5 assets we identified earlier. Can you split them into those 2 categories? Now may be a good time to pause the video. So you've had an opportunity to classify those assets, and here are the answers. The current assets, these are assets or belongings that a business will keep just in the short term, so less the time than a year. Debtors, we hope that debtors will pay us our money that we're owed ASAP. Cash, of course, cash, the most liquid asset. For more information on liquid assets, I'll leave a link in the description. And stock, otherwise known as inventory. Those are the current assets. Fixed assets, on the other hand, these are other things that belong to the company. We've got a van, which we imagine will be kept for longer than a year, and of course a warehouse. Now, the challenge question you'll notice at the bottom of the page was, is it best to have more current assets or more fixed assets? And this poses a large question that some people disagree on. You may wish to pause the video now to have a think about it. Now, people may come up with different viewpoints on this. However, if it was up to me, knowing that the majority of new businesses fail because of a lack of current assets, i.e. liquidity and ability to pay their short-term bills, I would say personally it's best to have a good amount of current assets. That said, fixed assets are also important. Some would say they're vital because generally several fixed assets will appreciate in value. For more information on appreciation, I've put a video link in the description. But essentially, fixed assets, several of them, several classes of fixed assets, property for example, will go up in value over time, which means that your business will be making a greater return on its investment. However, can't avoid the fact that most new businesses fail because they run out of cash. and therefore it's vital to keep a good supply of current assets. The next thing we'll need to do in our understanding of balance sheets is to classify liabilities. Liabilities can be once again put into two groups. Firstly, current liabilities. These are liabilities, debts, things that we owe, that a business will pay back in the short term. Short term, generally less than a year. Whereas long-term liabilities, these are liabilities, debts that a business will pay back in the long term. So generally, these debts will last much longer than a year. Let's see if you can classify the 4 liabilities on the screen into those two groups. So you've had a go at that and you've classified the liabilities into the two groups. The answers you can see are on the screen. In the current liabilities column, we've got creditors. It's highly unlikely that creditors, i.e. people that have given us trade credit, will wait around a long time for them to be paid. So therefore, we'll have to pay them in the short term, generally within a year or a lot sooner. Of course, wages, once again, our employees are unlikely to want to wait too long before they get paid, so wages are a current liability because we'll be paying that out in the short term. And thirdly, heating, lighting and water bills, utility bills you might say. Once again, a current liability because we'll pay for these in the short term. On the other hand, we've got long-term liabilities. Long-term, of course, things that will keep on paying for longer than a year, sometimes a lot longer. Out of those 4, the only one which really could be called a long-term liability is long-term loans. Long-term loans, of course, can be paid over many, many years, so that would be classed as a long-term liability. The challenge question at the bottom of the screen is explain 2 reasons why you might not get what you expected for your stock. If you want to have a go at that, now would be a good time to pause the video. Now that you've had a think about it, let's have a look at the reasons why you might not get what you expected for your stock, otherwise known as inventory. Now, stock, of course, is by its very nature, in some cases, perishable. What that means is some stock, for example, will go out of date. A supermarket will be particularly susceptible to this issue. Food has a best before date, and therefore, if it's not sold, the value of that stock will plummet, so you might not necessarily get what you would expect in monetary terms for your stock. Another reason why you might not get what you expect for your stock is because it could become obsolete. This is particularly important in highly moving, highly dynamic markets such as the technological industry. When technology moves forward, outdated, older stock becomes less valuable and will therefore command a lower price. For that reason, you might not get what you expected for your stock, and for that reason, many businesses try to have a high stock turnover. So in order to further deepen our understanding into balance sheets, I want to share a calculation with you, and this is how to calculate something called working capital. You can see the formula here. Working capital equals current assets minus current liabilities. And it's the amount of current assets therefore left over after all current liabilities have been paid. Now, why is it such a vital formula? Well, essentially, it's taking our current assets, our debtors, our stock, and our cash, adding all that up, and taking away our current liabilities. These are things like our creditors. Now, essentially, we want this figure to come out as a positive number. We want it to be greater than 0 because we want to have more current assets than liabilities. Why? Well, we want to be able to afford to pay our short-term debts. We want to pay our employees fairly and on time. We want to be able to pay our creditors for our stock. They won't want to supply us with too much more if we don't pay them, of course. And as we know, if we don't pay our utility bills, well, it won't be too good. We'll be working either in the cold or in the dark. So therefore, it's vital that we pay our suppliers, our wages to our employees, and our utility bills ASAP. And therefore, we've got to have a working capital of greater, at least, than 0. The challenge question at the bottom is why is it important for a business to maintain more current assets than current liabilities? Well, as we've just discussed, if you have more current liabilities than current assets, this is going to generate significant cash flow difficulties now or in the very near future. If you have more current liabilities, that suggests that you haven't got enough current assets, liquid assets, in order to be able to pay those short-term debts. And that could mean your stakeholders, such as your employees, your suppliers, or the utility company, might become increasingly frustrated with your inability to pay them. And therefore, of course, suppliers may choose not to supply you anything. Your employees may choose to leave, or at the very least be demotivated. And of course, your utility company may turn off your electricity or gas supply. So just to put it into context, we've got a situation here where we've got debtors, cash and stock, our current assets, and we've got creditors, wages and the heat, light and water bill for our current liabilities. How can we calculate working capital? Take one away from the other. That will give you a figure of £20,000 positive, so that's a good thing. We've got a positive working capital. However, you might have realised that only 5,000 out of our £50,000 of current assets is made up by cash, cash being the most liquid of all the assets. If you want more information on liquidity, by the way, I'll leave a link in the description. Now, the fact that such a small amount is made up by cash, and knowing what we know now about stock and the fact that we might not necessarily get what we expect for it, we could potentially still leave ourselves open to potential cash flow difficulties. So, now that we know what the components of a balance sheet are, on your screen you'll see a balance sheet in its entirety. You've got, along the top, you've got year 1 and year 2. This, of course, is a snapshot in time. It's not for the whole year. It's not like a profit and loss statement. This is simply a snapshot in time. So we assume that this snapshot is taken on the end of the financial year. You've got fixed assets first, then a collection of 3 current assets, then your current liabilities and your calculation of working capital. Now, you add up all of your assets and all of your liabilities, and you get total assets. Then we've got the bottom of the balance sheet. We've got owner's capital, of course, if it's a limited company, a private limited or a public limited company, it's called shareholder capital. And essentially, this is the value of the money that the shareholders or the owner themselves has put into the business. For example, in year 1, you can see the shareholders have put £20,000 into the business. And then we've got retained earnings, sometimes simply known as profit and loss account. And this is the retained earnings from trading within the business. So in year 2, for example, we can see is £30,000. And right at the bottom, we have something called shareholders' funds. Now, the reason why this is called a balance sheet, hence balancing, is because the total assets in year 1 you can see 70,000 always balances with the shareholders' funds. So what is shareholders' funds? Well, it's essentially the amount of equity within a company that belongs to the shareholders. The way it's calculated is owner's capital plus retained earnings. As you can see, in year 2, 20,000 plus 30,000 equals 50,000. And as I mentioned, the key thing about a balance sheet is that the total assets figure is always the same as shareholders' funds. So now you know what components make up a balance sheet, I've got a little activity for you. On your screen are 5 orange boxes. They represent 5 hidden figures within the balance sheet. Can you use your knowledge and expertise that you've gained thus far in order to complete what those missing figures are? Now might be a good time to pause the video if you want to give it a try. So let's have a look at some answers. Number 1 was to calculate the working capital, i.e. current assets minus current liabilities. So you calculated the 3 current assets in year 1, you added them up, 13, 12 and 25, and you got 50. And then you took away the 3 current liabilities, 22 plus 11 plus 7, so that is 40. That means, of course, that the working capital, the answer to question number 1, would be 10,000. Now, the second point is for fixed assets. Fixed assets. Now remember, fixed assets are assets that will keep for a long amount of time. Something like a van or a building, like a warehouse, for example. Now, how do we work out 2? Well, we have to almost reverse our thinking, if you know what I mean. So you've got the total assets figure of 70,000, and we know as we learnt earlier, total assets are a collection of all of the assets minus all of the liabilities. So we know that fixed assets plus current assets minus current liabilities, we haven't got any long-term liabilities here, will equal 70,000. So what we'll do then is therefore we'll work it in reverse. So 70,000 total assets plus the current liabilities of 40,000 will give us 110,000, and then we'll take away the current assets of 50,000. So 110,000 minus 50,000 will of course give us £60,000. You might be thinking that there's a second way to work this out, and indeed there is. Of course, we know that working capital takes into account current assets minus current liabilities already, and therefore a quicker way to do it, if we've got the figures available, is total assets minus working capital, and that will once again give us our £60,000 figure. The third box is a tricky one to work out. Now, we know that how to calculate working capital, we have to do the current assets minus the current liabilities. So we've got current assets of 7,000, 8,000 and 35,000 in year 2. So add them three together and you got £50,000. 50,000 minus the current liabilities must be minus 25,000, which is the working capital. So in total, the current liabilities must thereby equal £75,000, because 50,000 minus 75,000 would be minus 25. So how do we work out the wages figure? Well, in total, those three current liabilities have got to equal 75. So we've got creditors of 30, we've got a heating bill of £20,000. So therefore, wages for number 3 must be £25,000 as well. That will of course equal working capital of minus £25,000. As you can see, not a great position to be in. The reason I've put a few asterisks after that 25,000 negative is because negative figures in a balance sheet, or many financial statements for that matter, can be either shown with a negative sign in front of it, or more often than not, they're shown within brackets. So you'd often see that £25,000 within brackets, and that would mean it's a negative or minus figure. So how do we work out number 4? We know that total assets are all of the assets minus all of the liabilities. So there's a couple of ways we can do it. Firstly, we can total up all the assets. You've got fixed assets in year 2 of 75,000 and current assets of 50,000. So we add those two up, we get £125,000. Then we take away the current liabilities. Adding those three together, you get 75,000. So we take our asset figure of 125,000, we take away our liability figure of 50,000, and we're left with a figure of £50,000 for the total assets in year 2. But of course, there is a second way of doing this. We know, of course, that working capital has already taken into account the current assets and the current liabilities figure. So we could also simply go fixed assets of 75,000 plus the working capital, which in this case is minus 25,000. So therefore 75,000 minus 25,000 once again would give us our figure of £50,000. The final piece of the puzzle is, of course, number 5. How do we work out the retained earnings in year 1? Well, we know that the total assets figure and the shareholders' funds figure always have to balance, always have to match. They're the same figure. So we look at the total assets in year 1, which is 70,000. We look at the shareholders' funds, which is 70,000. Good, they match. So we also know that shareholders' funds is calculated by adding together the owner's capital. Remember, if it's a private and public limited company, it's called shareholders' capital. So we add that £20,000 to something under the orange box 5, the retained earnings, and it will equal the shareholders' funds. Now, rearranging the formula, of course, will mean that 20,000 plus 50,000 will equal a shareholder funds figure of £70,000. A challenge activity you might wish to consider at this point is, can you see any potential problems in the statement? What can be done about these issues? You may wish to pause the video at this point and have a think about any problems or potential solutions you can foresee. So you've had an opportunity to think and reflect upon this balance sheet. You've got the comparison of year 1 to year 2. And several things have happened. The fixed assets figure, firstly, has gone up. It's gone up from 60,000 to 75,000. Not necessarily a bad thing, of course. It could have happened for a number of reasons. The company could have invested in more fixed assets. They could have bought more vans, buildings, machinery, things that their business is going to keep for a long period of time. It could have been simply that the year 1 assets appreciated, went up in value. In this case, it would be up by 25%. We don't know the situation, but not necessarily something to worry about. Then we come on to the current assets figure. We can see that our debtors, people who owe us money, has gone down from 13,000 to 7,000 pounds. That, of course, could mean that we're more efficient at collecting money that we're owed. It could mean, of course, that we've sold less of our products and therefore haven't been as successful. Of course, that would be shown in the profit and loss account. Our cash holdings have also gone down by a half, actually, from 12,000 to 8,000 pounds. Cash being the most liquid asset, i.e. the most able to pay short-term debts, it's concerning that it's gone down by such a significant margin. So that's something that we might need a solution for. Stock holdings, on the other hand, have gone up from 25,000 in year 1 to 35,000 pounds. So we're holding a lot of stock. It's a worrying situation based upon what we talked about earlier and the fact that we might not get what we expect to get for the amount of stock we hold. And then we come on to our current liabilities, our creditors, people that we owe money to has gone up from 22,000 to 30,000 pounds, so a significant increase in the amount we owe. Likewise, wages, our current liabilities have gone up. Now, some might say that this is nothing to be concerned about. It could be down to a couple of reasons. Maybe we've employed more staff and therefore our wage bill has gone up. Fine, that could be it. It could be that we're paying our current staff, by the looks of it, significantly more, so they could be therefore much more motivated. However, it could be potentially because we might not have paid them on time for some time, and therefore our wage bill is increasing, it's creeping up, which once again would be a worrying issue. A heating bill has gone up significantly, and rather topical increase there because, as we all know at the moment, heating bills and many energy costs are going up and through the roof. But the fact is, it's gone up almost 3 times, so we'll have to look for a solution for that issue. Working capital, really concerning. Working capital has gone from a relatively healthy year 1 total of £10,000 to a negative figure. Now, a negative figure is always of concern because it suggests that we haven't got as many current assets to pay for our current liabilities, and in this case we've got £50,000 worth of current assets to pay £75,000 of current liabilities, so a large concern. But nonetheless, that's the main issues. Let's have a look at some solutions. You may wish to pause the video at this point if you wish to come up with some solutions for those issues yourself. So some solutions in no particular order. The first one is to sell off unused fixed assets to generate cash. As we said earlier, the fixed assets have gone up by 25%. That could mean that some of these assets have appreciated, but it could also mean that they might have bought new fixed assets and therefore not be using older fixed assets. If they're not using them, rather than paying to store, to maintain these assets, it might be worth selling them off. Of course, when you're ever selling a fixed asset, you might have to almost speculate to accumulate. You might have to pay out in advertising in order to then sell the asset. And of course, not all fixed assets appreciate, and therefore if you're selling a used van, for example, it's highly likely to have a much lower residual value than for what you bought it for. So fixed assets and selling them in order to generate cash does of course come with some negatives. The second thing you could potentially do is reduce the amount you've spent on stock. In this case, the stock holding is 25,000 up to 35,000. Now, how do you reduce the amount you've spent on stock? Of course, you could find a different supplier. Yes, of course you could. But you could also implement something called just-in-time. Just-in-time production means that rather than holding vast amounts of stock, as you can see, it's gone up to 35,000 here. Rather than holding that amount, you can forge a great relationship with your supplier, which means that they're more willing to provide you with stock at short notice. The benefit, of course, is that they will hold the stock for you, and that vastly reduces your storage costs. The third potential solution might be to reduce the amount spent on wages. As we mentioned earlier, wages have gone up significantly, they've more than doubled. This could be because you're being extremely generous with your workforce. It could be because you've hired more employees. But the fact is, if you've not hired more employees and you're just paying your staff a lot more, it might be prudent to reduce the amount you've spent on wages. Of course, if you've already increased the wage costs, this could be potentially very damaging to the business reputation, not just amongst the employees that work for you, but of course, social media uh, spreads things like wildfire these days, and we know that anything posted on there can damage your reputation amongst customers as well. The fact that you're not paying your well, if you've got more current liabilities in terms of wages as well, is just a concerning thing for any business because it might mean that if you're not paying your staff, they're highly likely to be demotivated and potentially leave the company. Reduce the amount spent on heating bill. That would be a superb option if it were that easy. Of course, as we know, heating bills have gone very high recently, what with the cost of living, of course. But there's not to say that this organisation can't look for a cheaper supplier. Of course, it's always wise, yearly potentially, to look for a cheaper supplier of energy and see if there's a cheaper deal elsewhere. A fifth possible solution could be to find cheaper raw materials. As we can see here, creditors have increased significantly from 22,000 to 30,000 pounds. Now, this is a current liability. This is something that we owe. Once again, the fact that it's gone up is contributing to our reduced working capital. Could we find cheaper raw materials so that our creditors figure, well, we find it much easier to pay them? Yes, we could. We could, of course. Not all businesses have that option, but many do. Of course, it would mean that we take the risk. We take the risk of potentially lowering the quality of those raw materials. If our quality goes down, of course, it could damage our reputation and therefore potentially lose customers. The sixth solution, of course, you may wish to consider is to arrange an overdraft. It's not a long-term solution, but it's a good short-term one. Banks are very willing to offer this. You might wish to watch some of my finance videos to confirm that statement. But if you've got a very low working capital figure, like this business do in year two, it's highly likely that cash flow difficulties are on the horizon, not that far away. So arranging an overdraft would be a good short-term solution in this case to potentially solving those imminent cash flow difficulties. A question you may wish to consider at this point is which of these solutions is best in this organisation's current situation. If you wish to have a go at this, now might be a good time to pause the video. In answer to your question, you might have very different viewpoints to me, and it's not to say that that's wrong, it's just how you justify it in a potential essay on the situation. If it was up to me, I'd firstly look at the easiest solutions which this company could make, finding cheaper heating suppliers, gas and electricity suppliers, for example. It wouldn't be too difficult just to put in a few calls or use a price comparison site. It might be a nice, simple thing that this company can do, and hey, we never know, it could make vastly different changes to their heating bill. A second thing that they may wish to consider doing is selling off unused fixed assets to generate cash. Now, the key point there is unused. Of course, if you're still using your fixed assets, it's probably unwise to sell them off. The only exception to this, of course, is sale and lease back. You may wish to sell your assets and lease them back from a company that specialises in doing that sort of deal. If you've chosen reduce the amount of stock you hold or the amount spent on it, reduce the amount spent on wages, or finding cheaper raw materials, that's absolutely fine, but at the same time, make sure you consider the negatives of those as well. Those will have potentially long and far-reaching knock-on effects. Arranging an overdraft, on the other hand, could be something that a business should do if they haven't already. Most businesses, it's highly likely, will have arranged an overdraft should they ever get into cash flow difficulties. But if they haven't, it would be a nice, straightforward thing to do. Check with their bank or their provider and see if they're able to arrange an overdraft, which is a flexible form of borrowing should they ever need it. So now that you've gathered that expertise, you know how to complete and amend one of these balance sheets. One of the past paper questions I've got is on the screen. You'll see it's just the same format as the one we've looked at in the past, year 1 and year 2. Have a go at it, see if you can calculate what would be under the boxes A, B and C, and then analyse solutions to the problems you see in the balance sheet. Now would be a good time to pause the video if you fancy having a go at this. Alternatively, just let it play and I'll provide you with the answers. So, what are the solutions then? Once again, we know how to calculate working capital by taking away current liabilities from current assets. The working capital figure is 4,050. B, the fixed assets, once again, we can work in reverse. Total assets plus, well, it would be a minus in this case, but plus 2810 will work backwards and give us our fixed assets of 22,600. And C, well, current assets minus current liabilities give us our working capital. So current assets take away liabilities. We have to work out the total liabilities in order to get to our minus 2,810. That would leave us with an overdraft of 9,650. So what issues have you spotted in this balance sheet? Our fixed assets have actually gone down over the 2 years, which means that potentially might have depreciated. Alternatively, we might have actually sold some of them to generate cash, although looking at the cash figure, it's highly unlikely that that's what's happened. More concerning is our working capital has gone from a positive to a negative, which suggests that cash flow difficulties are imminent. On top of that, cash holdings have gone down, and also the amount of people that owe us money have also gone down. So, possible solutions? Once again, there's no right or wrong answer, it's just how you justify it. But do remember, some of these will have more long-ranging, far-reaching impacts than others. So what else have you got to know in order to deepen your understanding on balance sheets and ensure you can answer any question on the topic? Firstly, you've got to fully understand depreciation. I'll leave a link in the description to a video I've made on the topic. Secondly, a new topic, a new concept, amortization. Essentially, it's when intangible assets are depreciated. Once again, a difficult, quite a complex concept to understand. I've done a video on it, check out the link in the description. Thirdly, trade receivables, debtors, and trade payables, creditors. You have to understand the difference in order to effectively complete, amend, and analyse balance sheets. Fourth, which is the most liquid of a business's assets? Now, you might have already done it, but ratio analysis is a key element of analysing balance sheets and profit and loss statements for that matter. So we have to understand which is the most liquid of a business's assets. I've done a video on it, check out the link in the description. Fourth, why is stock not considered as liquid as cash? We alluded to it earlier, but in order to turn stock into cash, we of course have to sell it first. Fifth, what's the problem with selling off assets to generate cash? We touched on it earlier. The fact is you might have to speculate to accumulate and spend money on advertising in order to generate enough interest to be able to sell your fixed asset. And finally, calculating working capital. Make sure you remember the formula. Current assets minus current liabilities. Click on the link for the next video in the series. It will really help to deepen your understanding of this complex business theory.